So imagine you're standing on the floor of this manufacturing plant in Nashik, Maharashtra.
hmm
The air is heavy. It smells faintly of like heated rubber and industrial lubricants. And you're just watching thousands of these glass molds dipping into vats of liquid latex, churning out a physical product that costs, a fraction of a dollar to produce.
Right. Highly commoditized manufacturing.
Exactly. A product that operates in a market weighed down by centuries of cultural silence and, honestly, just intense social friction. Now, take that image, pull up your brokerage account, and look at the valuation of the company running that floor.
Yeah, that's where the whiplash hits you.
It really does. Because you'd expect a slow, steady, maybe slightly stagnant industrial multiple. Instead, you're staring at a valuation that would make, it would make a Silicon Valley AI founder blush.
It's completely disconnected from traditional manufacturing valuation.
Right. So today's deep dive is into Cupid Limited, an Indian manufacturer that has somehow convinced the financial markets that it is this, like, hyper-growth juggernaut.
And that contrast is jarring, which is exactly why we're digging into the data today.
Yeah.
I mean, we are looking at a company that spent a 5-year period just crawling along.
Yeah. What was their historical top-line growth?
Like a historical sales growth rate of around 3%.
3%. Wow.
Yeah, it was predictable, almost utility-like in its sluggishness. But then suddenly, the operational reality fractures. They post over 100% revenue growth in a single quarter.
Wait, 100%? From 3% historical to over 100?
Over 100. Net profits jump nearly 200%. And the market responds by assigning them a 136x PE ratio.
Which is just wild.
It is. They're treating a legacy manufacturer of condoms and personal care products like a disruptive tech unicorn.
So if you're listening to this and you're looking at that 136x multiple, your immediate instinct is probably to just, run the other way.
Right, because you see a physical goods manufacturer trading at software multiples, and the alarm bells just start ringing.
Exactly. But before you write this off as some speculative bubble, you really have to look at the underlying cash conversion, the structural demographic shifts happening in India right now, and the highly specific moats this company has actually built.
Yeah, there's a lot going on under the hood here.
There is, and we have a massive stack of sources today. Company financials, market penetration estimates, deep structural analyses of India's healthcare demographics. Our mission today is to essentially dissect the tension between Cupid's historical execution, its sudden explosive momentum, and frankly, the brutal realities of the markets they're trying to conquer.
And to really understand that tension, we have to start with the physical machinery of the business itself.
Right, the core operations.
Exactly. Cupid's flagship revenue drivers are latex and non-latex male and female condoms.
Right.
And the sheer volume of their output is, well, it's the first variable we need to isolate here.
Because it's massive.
It's massive. We're looking at an annual capacity of over 480 million male condoms and another 52 million female condoms. But, capacity alone doesn't justify a premium multiple.
Right, anybody with capital can build a factory.
Exactly. The actual structural advantage here is their regulatory standing. They hold this distinction of being the first company worldwide to secure WHO and UNFPA pre-qualification for both male and female condoms.
Okay, let's break down the mechanics of that WHO pre-qualification, because I feel like that's not just some certificate they frame in the lobby.
No, absolutely not. It's a grueling process.
Right, because proving to the United Nations that a factory in India can reliably and safely supply public health programs in, say, the Congo or Syria, that requires this agonizingly strict compliance apparatus.
Oh, the bureaucratic friction is immense. We are talking about continuous batch testing.
Right.
Water leak tests, airburst capacity limits, strict tensile strength requirements. It's constant.
And maintaining that standing must just eat up overhead.
It does, but that's the beauty of it. It is a massive barrier to entry. Because when global health organizations or, local ministries of health issue tenders for HIV and STD prevention programs, that WHO stamp is the baseline requirement just to submit a bid.
So you literally can't even play the game without it.
You can't even walk on the field. Local, fragmented competitors who might, try to undercut Cupid on raw price, they simply cannot afford the continuous compliance overhead to maintain that certification.
Ah, so that single regulatory moat allows Cupid to export to, over 125 countries?
Yeah, over 125. which effectively insulates a huge portion of their revenue from pure domestic price wars.
It effectively acts as a global license to print volume.
Exactly.
But when you turn from their export markets back to their domestic Indian market, the TAM, the total addressable market, starts looking like an absolute gold mine.
Oh, the demographics are staggering.
Right.
The estimates place the Indian TAM at somewhere between 5,000 to 10,000 crore rupees annually. And the math behind that is pretty straightforward. You take India's 1.4 billion population, you isolate the 15 to 20% who are sexually active adults, and you just apply a moderate usage benchmark.
Yeah, and then add the global export TAM, and you're looking at another 2,000 to 5,000 crore on top of that.
Right. But the math might be straightforward, but the reality of the market penetration is completely fractured, isn't it?
Completely. That multi-thousand crore TAM is almost entirely theoretical at this stage.
Wait, theoretical? How so?
Well, when you look at the actual national family health surveys, the current Indian market only serves about 5 to 10% of that adjustable baseline.
Only 5 to 10%.
Yeah, usage rates are hovering at less than 5% among sexually active individuals. I mean, there is a staggering disconnect between the biological reality of the demographic and the commercial reality of the sales figures. That 90 to 95% gap is fascinating because analysts always look for the bottleneck, right? Like in software, the bottleneck is usually broadband access or a clunky user interface.
Right.
But here, the bottleneck is entirely psychological. It's cultural. It is this taboo moat.
The taboo moat. That is the perfect way to describe it.
Think about the physical mechanics of purchasing this product in a traditional Indian retail environment. You walk into a brightly lit neighborhood pharmacy. It's often crowded with your neighbor.
Yeah, everyone knows everyone.
Exactly. You have to verbally request the product from a pharmacist across a counter or pick it up from a shelf in full view of the store. That interaction carries a massive social friction tax.
The friction tax is a brilliant way to conceptualize it, really.
Yeah.
Because cultural stigma acts as this macroeconomic drag on the entire category.
Right.
It keeps flashy new entrants at bay because the marketing spend required to overcome that stigma is just prohibitive.
It's too expensive to educate the market.
Exactly. But simultaneously, it suffocates the incumbents. You have tens of millions of potential consumers who simply opt out of the market because the awkwardness of the transaction outweighs the perceived utility of the product.
So the open market remains unserved not because of price, but because of distribution mechanics.
Precisely.
So the multi-million-dollar question here is, what actually dismantles a taboo moat? You have this demographic powder keg India's youth bulge with roughly 900 million people in that 15 to 49 age bracket. How do structural forces convert that silent demographic into actual quarterly volume growth for Cupid?
Well, it requires a convergence of two things: urbanization and digital infrastructure.
Okay, lay that out for me.
Urbanization is the slow-burning catalyst, right?
Okay.
As populations migrate from tight-knit rural villages to dense urban centers, they naturally acquire a layer of anonymity.
Sure, buying something in Mumbai is different than buying it in a village of 500 people.
Exactly. Buying a personal care product in a sprawling city pharmacy carries way less social risk than buying it from the pharmacist who, knows your entire family. And the data backs this up. There's a direct correlation between urban density and higher usage rates.
Makes sense.
But the true structural unlock, the variable that entirely neutralizes the taboo, is e-commerce.
Because it completely eliminates the human interaction at the point of sale.
100%. The digital storefront offers absolute privacy. When a consumer can browse variants on their phone, complete the transaction digitally, and then have the product delivered in an unmarked brown cardboard box right alongside their groceries.
The friction tax drops to zero.
Drops to zero. E-commerce platforms act as a behavioral bridge. Currently, online sales only account for roughly 10 to 20% of the total category volume. But as smartphone penetration deepens and quick commerce delivery networks expand.
Think Zepto, Blinkit, those 10-minute delivery apps.
Exactly. That digital channel is the primary mechanism for accessing the 90% of the TAM that has been historically inaccessible.
And what e-commerce also does, fundamentally, is it alters the purchasing behavior itself. Like in a physical pharmacy, you want to complete the transaction and leave as quickly as humanly possible.
Get in, get out.
Right. But online, the platform's algorithm suggests add-ons. It builds basket size. And this creates a natural pathway to discuss Cupid's secondary business lines.
Yes, the adjacencies.
Because they are aggressively pushing beyond their core latex manufacturing, we're seeing expansions into water-based personal lubricants, in vitro diagnostic kits, and even FMCG categories like almond hair oil, deodorants, and perfumes.
Yeah, the lubricant expansion is probably the most logical adjacency there. The Indian TAM for personal lubricants is estimated at around 500 to 1,500 crore rupees.
So still pretty sizable.
Very sizable. And similar to condoms, less than 5% is currently served. The financial leverage here is the co-usage rate.
Okay, what does that look like?
Well, globally, the co-usage of lubricants with condoms sits around 15%. In India, it is significantly lower than that. But as the e-commerce algorithms bundle these products together at checkout, frequently bought together.
Right, the classic Amazon upsell.
Exactly. Cupid can capture dual revenue streams from a single customer acquisition cost.
Okay, the lubricants make perfect sense. They're a totally natural extension of intimacy products. But I have to push back hard on their other diversification strategies, particularly the FMCG pivot into hair oil and deodorants.
I don't blame you.
I mean, I was looking at their established competitors in those spaces, multinationals, with decades of consumer psychology research and astronomical marketing budgets. You don't just decide to wake up one morning and compete in the Indian hair oil market.
No, it's brutal.
Cupid is a late entrant with maybe, a 1 or 2% share in a highly saturated 50,000 to 100,000 core TAM. They have 28 years of highly specialized latex processing expertise. Why dilute their focus and capital by slapping a label on a commodity personal care product where they have literally zero structural advantage?
Your skepticism is entirely warranted. The FMCG expansion carries all the hallmarks of classic, unfocused corporate diversification.
Diversification, as they call it.
Exactly. The data just does not suggest Cupid possesses any unique manufacturing edge or distribution dominance in hair oil or perfume. And if you look at their recent marketing efforts in these categories, they lean heavily on promotional phrasing claims like made in India with Japanese quality.
Which usually indicates a complete lack of underlying product differentiation.
Right. It's a highly competitive retail battleground where they are severely outgunned by giants like Marico or HUL.
It honestly feels like an ego play rather than a strategic allocation of capital. But let's look at the other pivot, the in vitro diagnostic kits, the IVD segment.
This one is far more interesting.
Yeah. This includes rapid tests for HIV, dengue, malaria, pregnancy tests. The TAM here is massive, roughly 5,000 to 10,000 crore rupees in India alone. But currently, Cupid holds less than a 5% share. And the landscape is notoriously difficult, right? With 70 to 80% of rural diagnostic testing functioning through completely unorganized, informal setups.
And within the organized 20 to 30% of the market, imports dominate nearly half the volume.
Right, so it's tough.
It is. Cupid is entering a highly specialized medical device arena against entrenched players. However, unlike the hair oil venture, the IVD pivot actually possesses a credible underlying strategic logic.
Okay, sell me on it.
You have to examine their institutional distribution channels.
Oh, I see where this is going. It's the government tendering relationships.
Exactly that. Cupid's core business relies heavily on supplying massive bulk orders to government health ministries and global NGOs. They have spent decades optimizing their B2B compliance, learning the intricacies of the L1 bidding system.
Where the lowest bidder who meets quality standards automatically wins the contract.
Precisely. They know how to navigate that institutional bureaucracy better than almost anyone. Now look at the macroeconomic shifts happening in Indian public health right now.
Right, initiatives like the Ayushman Bharat program.
Yes, Ayushman Bharat is aggressively expanding rural healthcare infrastructure, and a key component of that program is mandating point-of-care rapid diagnostic testing at local health centers.
So they are essentially leveraging an existing highly optimized distribution pipe.
Yes.
They already have the procurement officers on speed dial for latex products. So when the ministry suddenly needs 10 million dengue rapid tests, Cupid is already an approved, trusted vendor in the system.
Exactly. They aren't fighting a retail marketing war for consumer attention in a pharmacy aisle. They're cross-selling higher-margin diagnostic kits to their largest institutional B2B clients.
That is a massive structural advantage. And I guess the compliance infrastructure required to pass a WHO condom audit translates pretty well to the quality control required for manufacturing rapid diagnostic kits.
It translates perfectly. The IVD pivot capitalizes on their existing B2B relationships and their manufacturing discipline. It makes it a far more defensible strategy than trying to win shelf space for deodorants in a local supermarket.
Okay, that makes sense. And the strategic logic of that institutional supply brings us to probably the most baffling and fascinating part of the Cupid narrative, their financial engine.
The numbers.
The numbers. In the personal care manufacturing space, Cupid is routinely referred to as the king of margins.
It's true.
Let's look at the anomaly of their Q3 FY26 results. Operations revenue came in at 93.51 crore rupees, which is a 101.7% year-over-year increase. Incredible on its own.
Very strong.
But the net profit absolutely exploded. It jumped 196.6% to 32.87 crore. We are looking at a business with an average selling price of maybe 10 to 50 rupees per pack, yet their structural gross margins consistently hover around 54 to 60%.
Which is software territory.
Right. How is a manufacturer producing cheap physical goods achieving software-like gross margins?
The gross margin profile is a direct function of their raw material economics. The primary input is natural rubber latex. And even factoring in global commodity fluctuations, latex and the basic packaging materials constitute only about 20 to 30% of the revenue in terms of cost of goods sold.
So the input costs are just incredibly low.
Incredibly low.
Wow.
When your core physical input is that cheap, and you've spent 3 decades optimizing the vulcanization and dipping processes to minimize wastage, the gross profit generated per unit is immense. But the real magic, the reason profit growth outpaced revenue growth so violently in Q3 is the nature of their fixed costs.
This is the phenomenon of high operating leverage.
Yes.
And it's best understood mechanically, right?
Yeah.
Think of Cupid's manufacturing plants like building a massive toll bridge.
Okay, I like this analogy.
Right, so constructing the bridge, buying the land, pouring the concrete, installing the steel that costs an absolute fortune. The first car that crosses that bridge effectively costs you millions.
Yeah.
But the 10 millionth car, the physical cost of that single car crossing is zero. It is pure profit. And Cupid operates the same way. They have massive fixed overheads. They have your machinery depreciation, the factory maintenance, the salaried plant managers.
That toll bridge metaphor perfectly captures the financial physics at play here. Because once Cupid sells enough volume to cover those base factory overheads, their break-even point is cleared. From that moment on, the marginal cost of producing one additional condom is basically just a few cents worth of liquid latex.
So the revenue from every incremental box sold just bypasses the heavy fixed costs and falls almost entirely to the bottom line.
It goes straight to the bottom line. That is how a 101% increase in revenue translates into a 196% increase in net profit. The machinery is already paid for. The extra volume just prints cash.
And the knock-on effect of that operating leverage is what makes the balance sheet so pristine. Maintaining a 34% ROE and an estimated ROCE pushing 40% in a heavy manufacturing business isn't just good, it's a structural anomaly.
It's phenomenal.
It means they aren't trapping their capital in constantly degrading factory equipment. They are turning raw rubber into liquid cash incredibly efficiently. And critically, they have a completely debt-free balance sheet.
No leverage, no interest payments.
Exactly. They don't have interest payments eating into those margins.
Which leads to near-perfect cash conversion. Almost 100% of their net profit translates directly into free cash flow. And this creates an entirely new strategic variable, the cash hoard.
Oh, right, because recently the board approved a 4-to-1 bonus issue?
Yes, they did. And while the bonus issue itself merely changes the share structure without creating underlying value, it serves as a very powerful signal to the market.
It telegraphs that the management is sitting on a substantial unencumbered war chest.
Precisely.
But a war chest is only valuable if it is deployed. Sitting on cash in a high inflation environment destroys value. With zero debt and massive free cash flow, they have dangerous optionality. They could aggressively fund new capacity to flood the export market, or they could initiate brutal price wars domestically, utilizing their 60% gross margins as a weapon to just bleed out the unorganized sector who operate on razor-thin margins.
They could. Or they could utilize that cash to fund the aggressive marketing required for their premiumization strategy, attempting to move upmarket into branded luxury intimates. But the central tension for anyone analyzing this company remains. Is this cash-generating machine sustainable?
That's the million-dollar question.
Because a blowout quarter with 37% EBITDA margins is a phenomenal operational achievement. But you have to determine if this was driven by a one-off, highly lucrative government tender that just happened to fall in Q3, or if the structural baseline of the business has permanently shifted upward.
And this brings us squarely to the growth paradox. This is the central dilemma driving that 136x PE ratio. We are trying to reconcile two completely different realities. On one side, you have the marathon, a 5-year historical sales growth average of roughly 3%, which barely outpaces inflation. On the other side, you have the sprint. Recent quarters posting 87 to 101% growth. We really need to dissect the actual physical vectors driving this sudden spike.
Well, the data points to four specific growth vectors.
Okay, let's hear them.
First, geographic expansion, which is highlighted by a recently secured massive order book from Saudi Arabia.
Right.
Second, deeper domestic penetration, finally starting to chip away at that taboo moat through e-commerce like we
This
discussed.
quick commerce unlock.
Yep. Third, a massive scale-up in manufacturing capacity. They recently added the ability to produce an additional 770 million male and 75 million female condoms annually.
Which is a huge jump.
And finally, the premiumization pivot, shifting production lines toward flavored, branded, and health-focused variants that command higher shelf prices.
But we have to rigorously separate the signal from the noise here. We must distinguish between structural tailwinds that lift the entire sector and execution-dependent bets that rely entirely on management competence.
Absolutely.
Because India's rising health awareness, the urbanization trends, the shift to digital purchasing, those are structural tailwinds. They provide a rising tide for everyone. But the Saudi Arabia order book, that is highly execution-dependent.
Extremely.
Fulfilling a massive cross-border institutional order requires scaling production lines perfectly, maintaining zero-defect quality control across millions of units, managing complex shipping logistics, and absorbing heavy working capital requirements. A single failure in that chain breaks the narrative.
It breaks the narrative entirely. And the market is currently assigning zero probability to any execution failure.
It is zero.
Trading at a 130 to 140x PE multiple is staggering. To contextualize that, the average multiple for the nifty FMCG sector, which includes established giants with impenetrable brand moats, is roughly 35 to 40x.
Wow.
And Cupid's own 10-year historical average is 23x. The current valuation is priced for absolute, uninterrupted perfection.
It implies the market firmly believes the 3% historical growth rate is just a permanent relic of the past. The 136x multiple mathematically demands that Cupid is now structurally a hyper-growth company and will remain one for the foreseeable future.
Which is a bold assumption.
Very. If a stock's historical reality is a sluggish crawl and the market is pricing it based on one massive Middle Eastern order book and a theoretical e-commerce unlock, investors are walking an incredibly dangerous tightrope.
It is the ultimate priced-in premium, and the vulnerability of that premium is highest when you examine their premiumization strategy.
Okay, unpack that for me.
Look at Cupid's corporate DNA. For nearly 3 decades, they have been a B2B manufacturer. They excel at winning government tenders, producing unbranded or minimally branded products in massive bulk quantities and shipping them out in shipping containers.
Right. They operate in a world where the lowest price and regulatory compliance win the contract.
Exactly. Now, they are attempting to pivot into the B2C space, selling high-margin, heavily branded luxury intimates directly to consumers. And they are doing this in one of the most price-sensitive retail markets on Earth.
Building a luxury consumer brand requires an entirely different corporate musculature. You don't just win a consumer's loyalty by passing a WHO audit.
No, the consumer doesn't care about a WHO audit.
Exactly. You need deep psychological insights into consumer behavior, astronomical marketing and influencer budgets, and the retail muscle to fight for premium shelf space. It is a completely different game than winning a public health procurement contract.
It really is. And if they fail to build that consumer brand equity, and let's say the Saudi order book proves to be cyclical rather than a recurring annual contract, that 136x multiple will face a violent contraction.
The market does not tolerate 3% growth from a stock priced for 100% growth.
It will punish it severely. This requires us to map out the specific catalyst that could trigger that contraction. What are the systemic vulnerabilities that could pop this valuation bubble?
Let's start with the most immediate threat to their core condom business: multinational competition. Cupid is operating in a sandbox with global giants like Durex, which is owned by the conglomerate Reckitt Benckiser and Okamoto.
Behemoths.
These are massive entities with essentially bottomless marketing budgets and decades of consumer brand loyalty.
The existential threat here is a targeted price war. Cupid relies heavily on its 54 to 60% gross margins to fuel its incredible cash flow and ROE.
Right.
If Durex or Okamoto decide they want to aggressively capture Cupid's 10 to 15% domestic market share, they have the balance sheet to absorb short-term losses. They could flood the Indian retail and e-commerce channels with cheaper, highly branded alternatives.
Just bleed Cupid out.
Exactly. If Cupid is forced to slash prices to maintain volume, driving those gross margins down from 60% to, say, under 10%, the financial engine stalls completely.
Because of that same operating leverage we discussed earlier, it works in reverse, too. If the revenue drops below the break-even point of those massive fixed plant costs, the losses accelerate just as violently as the profits did. Earnings could slash by 30 to 50% instantly.
Instantly.
And when earnings collapse on a stock trading at 136 times earnings, the D-rating is catastrophic. Theoretically, the stock price could collapse back toward its book value, which currently sits at a mere 2.84 rupees per share.
The downside risk is immense.
It's terrifying.
And, the commercial pricing risk is arguably secondary to the regulatory risk.
Oh, right, because condoms are classified and regulated as medical devices.
Yes. Because Cupid relies so heavily on its export business, shipping to over 50 different countries, they are simultaneously navigating 50 different regulatory frameworks, 50 different versions of the FDA.
The compliance burden must be a complete logistical nightmare.
It is a nightmare. A single failed batch audit, whether it's a slight microscopic deviation in latex thickness or a failure in breakage rate testing at a destination port, could trigger an immediate recall.
Wow.
Worse, it could trigger a suspension of their WHO prequalification. If that stamp of approval is revoked, their institutional export business halts overnight. You can see 20 to 40% of their revenue vaporize instantly.
And furthermore, all that newly added capacity, those 770 million new units they just built the infrastructure for, suddenly becomes dead weight.
Yeah.
The machinery just sits idle, generating zero revenue, while the fixed costs continue to burn through their cash reserves.
Exactly. It's a house of cards if the compliance slips even slightly.
Then you have the vulnerability of the raw materials themselves. Take the lubricants business, or even the core latex production. The gross margins look incredible today, but they're highly exposed to global unhedged input cost volatility.
Yes, the commodity risk.
If there is a supply chain shock in Southeast Asia and the price of raw latex or glycerin spikes unexpectedly, the math changes overnight.
That is the perpetual Achilles heel of a high-volume manufacturing business. Raw materials constitute 35 to 40% of the revenue structure. If global latex futures suddenly spike over $2 a kilogram, Cupid's management faces a brutal dilemma.
They can either absorb the inflated cost, watching their celebrated 37% EBITDA margins evaporate in a single quarter.
Right. Or they can attempt to raise the retail price.
Right.
But because they lack deep, impenetrable consumer brand loyalty, raising prices means immediately bleeding market share to the fragmented, unorganized players who operate with minimal overheads.
They just don't possess the pricing power to simply pass macroeconomic shocks onto the Indian consumer without consequence.
They really don't.
So let's pivot to the technological risks in their newer ventures, specifically the IVD segment, the diagnostic kits. We established why they entered the space to leverage government B2B channels.
The tendering logic, yes.
But the underlying technology they are manufacturing is highly vulnerable. They are producing rapid tests based on traditional antibody or antigen lateral flow mechanisms.
Right. It is the legacy technology of the diagnostic world.
Exactly. When I look at their IVD strategy, it feels like Cupid is investing millions to build the world's absolute best DVD manufacturing plant right at the exact moment global streaming infrastructure is coming online.
That's a great way to put it.
Because the medical community is rapidly advancing toward next-generation molecular point-of-care tests and CRISPR-based diagnostics, which offer radically higher accuracy rates. If those advanced technologies become cheaper and become the new standard for public health, won't Cupid's entire lateral flow manufacturing capacity become instantly obsolete?
The DVD and streaming metaphor is highly accurate here. The vulnerability of lateral flow tests was highly publicized during the COVID pandemic, specifically regarding the high rate of false positives and negatives compared to PCR testing.
Right, everyone remembers those debates.
Exactly. If the Indian Council of Medical Research or global bodies like the WHO decide that legacy lateral flow tests are no longer sufficient for public health mandates, and they pivot tenders toward molecular testing, Cupid's entire diagnostic narrative breaks.
Just evaporates.
Their addressable demand could evaporate by 40 to 60% within a few short years. And crucially, there is no evidence in the current financial data or public filings that Cupid is aggressively pivoting its R&D budget toward molecular technology. They appear to be doubling down on optimizing the legacy formats.
So if you are an investor, you are staring at a gauntlet of existential threats. You have the constant threat of MNC price wars, the high-wire act of pleasing 50 different global regulatory bodies, the vulnerability to latex commodity spikes, and the looming technological obsolescence of their diagnostic division.
It's a minefield.
Navigating a landscape that complex requires exceptionally visionary, battle-tested leadership. We need to look at who is actually at the wheel of this company and whether they have the experience to justify the valuation.
The leadership dynamic is perhaps the most heavily debated variable in the entire Cupid story. The current chairman and managing director is Aditya Kumar Halwasia. He was appointed to the position in October 2023.
Which means his tenure at the helm is roughly 2.4 years. In the context of industrial manufacturing, 2.4 years is incredibly brief. He is effectively a new variable.
He is new, but his alignment with the company's financial success is absolute. The most critical data point regarding his leadership is his ownership stake. He personally owns 32.84% of Cupid's outstanding shares.
32%. Wow.
Yes. At current market valuations, that stake is worth roughly 35.02 billion rupees. Now contrast that staggering equity position with his total yearly executive compensation, which sits at around 10.95 million rupees.
Wait, his actual salary is a rounding error compared to his equity position? It's pocket change.
Yeah, exactly.
This is the purest definition of skin in the game. His personal generational wealth is inextricably tied to the performance of the stock. He's not a hired executive trying to hit a quarterly bonus target. He is an owner-operator.
That ownership structure perfectly aligns his incentives with the minority shareholders. If he misallocates capital, initiates a disastrous price war, or fails a regulatory audit, he isn't just risking his job, he is destroying his own net worth on a massive scale.
The ultimate motive.
And it must be acknowledged that the operational execution under his brief tenure has been undeniably spectacular. Q2 and Q3 of FY26 were blockbuster quarters that completely altered the trajectory of the company. He has publicly guided the market to a 335 crore rupee top line for FY26, and based on the recent run rate, they seem firmly on track to hit that target.
Okay, the recent execution is flawless. But when I look at the governance structure surrounding him, the red flags are impossible to ignore. A CEO cannot scale a company to a 136x multiple alone.
You need a deep team.
The entire board is relatively new, mirroring his tenure with an average of just 2.4 years. But the real concern is a dense family concentration at the top. You have Aditya Kumar Halwasia as the managing director, Ajay Kumar Halwasia sitting as an executive director, and Kuldeep Halwasia holding the titles of chairman and executive director.
The concentration of familial power is a classic characteristic of traditional Indian mid-cap companies. But it becomes a severe liability when a company attempts to scale into a global, institutional-grade organization. When your board is dominated by family members, the natural checks and balances of corporate governance are inherently compromised. Furthermore, when you analyze their organizational chart, there is a terrifyingly shallow bench of talent below the C-suite. There is almost no public visibility or data regarding seasoned business heads, independent deputy general managers of operations, or robust succession planning.
It feels less like a multinational corporation preparing to battle Reckitt Benckiser and more like a massive, highly profitable family office.
That's a very fair assessment.
The lack of organizational depth is the ultimate bottleneck. Hitting a 335 crore guidance through sheer momentum, a great Saudi order book, and an aligned CEO is one thing. But sustaining hypergrowth, managing the complexities of 125 export markets, and justifying software-like valuations year after year requires deep, professionalized middle management.
It represents extreme key person risk, and institutional investors loathe key person risk. We have evidence of Halwasia's ability to execute perfectly during a bull run, but we have absolutely zero evidence of his track record prior to 2023.
We don't know how he operates in a crisis.
Exactly. We don't know how he or this family-dominated board will react during a severe macroeconomic downturn. We don't know how they will manage capital allocation if latex prices triple, or how they will navigate a brutal margin-crushing price war with multinationals, simply because they haven't had to do it yet.
They haven't tested.
No. If Cupid intends to maintain that 136x multiple, they cannot rely on momentum. They must transition from a closely held family operation into a transparent, professionally managed institution. The lack of transparency around related party transactions and the absence of a seasoned executive layer puts a hard structural ceiling on their maturity.
Let's pull all of these complex threads together. We have journeyed through the entire mechanical and financial landscape of Cupid Limited today. On one hand, you're looking at a completely debt-free cash machine.
Printing money.
They are operating with unbelievable 60% gross margins, generating immense free cash flow, and sitting on top of a massive, underpenetrated Indian demographic gold mine. They are currently riding the high of explosive export orders, brilliant capacity expansion, and spectacular recent execution under deeply aligned new leadership.
But the counterweight to that bullish narrative is severe. The market has priced this company for absolute, uninterrupted perfection. To justify their valuation, they must permanently escape the gravity of their own sluggish history.
Which is incredibly hard to do.
They must face down terrifying multinational competition with deep pockets, navigate constant severe regulatory hurdles across 50 countries, and survive the looming technological obsolescence in their diagnostic categories. And they have to do all of this while relying on a relatively unproven, family-dominated management structure.
And when you trace all the data back to its source, it all revolves around that taboo mode. The massive multi-thousand crore open TAM in India exists almost entirely because cultural stigma acts as a physical barrier at the retail counter. But demographics are destiny. As urbanization accelerates, as digital privacy via e-commerce becomes the norm, that stigma will inevitably erode. The market will become mainstream.
Which brings us to the ultimate paradox of Cupid's entire business model.
Exactly. So I'll leave you with this final thought to mull over, a dynamic not explicitly answered in any financial filing. If the cultural taboo is the only thing keeping the massive, well-funded global giants from aggressively marketing to the Indian consumer, what happens when it disappears?
That's a good question.
Will the end of the cultural silence finally unlock Cupid's ultimate destiny as a hyper-growth demographic juggernaut? Or will the evaporation of that taboo simply remove the only structural moat they ever really had, inviting the global giants in to effortlessly steal their crown? Keep questioning the narrative behind the numbers because in the business of intimacy, the real financial machinery is always operating just beneath the surface.